Distinguished guests, fellow VC colleagues, investors, founders, and friends, it gives me great pleasure to welcome you to Genesis Forum 2021, brought to you by Genesis in collaboration with our partners, SMU Institute of Innovation and Entrepreneurship, and PwC Singapore.
Ladies and gentlemen, my name is Jeremy, and I'm the co-founder and managing partner of Genesis Alternative Ventures. It gives me great pleasure to welcome you to the Genesis Forum 2021. A year ago, the world looked like it was going to end. As an entrepreneur, you go through these crazy lows and crazy highs. These words from Anthony Tan, CEO of Grab, will resonate with everyone here, whether you're a professional, students, or entrepreneurs alike. Amid this landscape, we thought it would be useful to provide a platform for thought leaders, entrepreneurs, enablers, and service providers across the venture and investment space to have meaningful conversations on a range of diverse topics that are live in today's post-COVID world. With this in mind, we've curated a diverse set of topics for us today, from debt to equity capital raising, discussing the trials and tribulations of impact investing, and introducing you to startup leaders on the front line building their companies as COVID unfolds in front of them. And before I close off, I wanted to touch on a subject that's close to our hearts. Obviously, venture debt. Genesis is, after all, a Southeast Asia venture debt fund that is investing in and backing Southeast Asian tech founders and companies. Venture debt is still significantly undertapped in the region, and the Genesis mission is to bring better awareness of debt financing for venture-backed companies.
My name is Ben, and I'm co-founder and partner of Genesis Alternative Ventures. We have a couple of items on the agenda today. First, the inimitable Datuk Sri Nazir Razak, who will deliver the keynote address, which I'm warned, by the way, is not for the faint of heart, so listen closely. Thank you very much once again, Datuk Sri. After Datuk Sri, we have Patrick Yeo, venture leader at PwC Venture Hub, who will launch a new Southeast Asia ecosystem report on venture debt published jointly by PwC Singapore and Genesis. This is followed by a two-panel discussion with really wonderful selection of diverse speakers. The first panel discussing capital raising and capital structures in a post-COVID environment, and the second panel examining impact and ESG investing in Southeast Asia. Thereafter, we have Harvey Tor, Chief Investment Officer of SMU, who will address us on the role of tertiary institutions within the innovation landscape. Last, and certainly not least, we separate into 3 breakout rooms to engage with startups and startup founders and leaders, on various topics, including financial inclusion and fintech, the future of work and living post-COVID, and the resilience of Indonesian startups. I must give thanks to our panelists and moderators, some of whom are in the greenhouse today, but most of whom are calling in from as far afield as Seattle, London, Cologne, Tokyo, Taipei, Jakarta, and Kuala Lumpur. Thank you so much to each of you for accepting our invitation to join today and for sharing your experience with all of us.
I'm thrilled to be addressing you. I had a long career in finance, starting out as an investment banker back in KL in 1989. It was a time when emerging markets were just being uncovered as an exciting asset class, when we believed in the Friedman doctrine that the only duty of the company was to maximize shareholder value, when we pretended to look up to Wall Street's Gordon Gekko for his fashion sense, but in reality, we also worshipped his mantra that greed is good. And it was a time when governance, rules, and regulations were always 3 to 4 steps behind financial innovation and indeed naughty financiers. I remember many moments thinking, this isn't right or that isn't proper, but I stayed on, I stayed in. So when I look back, I consider myself one of the guilty ones. I feel a sense of obligation to now be part of efforts to find a better, more sustainable path for finance and capitalism. I cannot yet claim that everything I do is on that path, but at my family office and the National Development Bank that I chair, we already do place purpose first. In 2007, we set up the CIMB Foundation as the bank's CSR vehicle to genuinely give back directly to society. 10 years later, CIMB again set the standard by making the voluntary commitment to set aside 1% of annual profits for CSR. In recent years, though, I have begun to realize that profit maximization come CSR wasn't enough. Profit should not be the prime motivator. Doing well shouldn't just be about profits. We at ZAC Capital, my family office, invest in opportunities that pass our internal impact test. We don't invest just to make a return. We invest when we think that our capital can be part of making an important contribution to a bigger cause. Are we sacrificing performance in our quest for purpose? Perhaps, but not necessarily. There's plenty of data that shows that investors and companies that drive impactful outcomes can also deliver strong returns and profit. So how do we square the circle to marry capitalism's survival of the fittest tenet with a purpose-first culture, to compel today's generation to work in order to make things better for future generations? I do not have the answers, but I think we have to engineer reforms on multiple fronts. Let me just share 5 thoughts on moving towards a more sustainable and fairer financial system. 1. Market participants and private enterprise will not go very far in self-reforms. In the end, they are wired to fight to win and be paranoid about each other. We will need bigger governments to impose rules on ESG and CSR and ensure compliance. 2, I think accounting rules can be used to realign behavior, for instance, by charging for social costs like damage to the environment. Nothing drives corporate behavior more than real P&L. Thirdly, I think tax systems have to be more progressive so as to afford more effective safety nets and redistribution policies. 4th, I think there needs to be better international coordination on ESG and taxation to minimize cross-border arbitrage. Degradation of the environment and amplifying inequality cannot be inter-nation competitive tools. And finally, I think governance frameworks should encourage or even ensure greater diversity on boards, not just in gender, but also in age, ethnicity, and backgrounds, so that companies are more in tune with society at large. Let me just conclude to say that from the vantage point of an old-time finance professional, I would like to call on my fellow old-timers to step up and help make a better financial system. We owe it. As for the younger generation, until we overhaul the system comprehensively, you must live with the imperfections, but this shouldn't stop you from imposing your own better value systems and self-restraints to progress a better, more sustainable and fairer financial system. I love that Genesis embodies this spirit. I'm glad to be part of their network, and I'm honored that they have let me have your attention this morning. Thank you very much.
I think without further ado, let's talk about, in terms of what PwC has been doing in the ecosystem. We have been very engaged in the ecosystem, helping both investors as well as entrepreneurs to navigate the landscape. I think a bit similar to what Martin has mentioned. I think our value proposition is to make sure that we are there for you and startups as well as the investors. Now, in terms of the venture debt report, we believe that this is a new growth mantra for startups in Southeast Asia. And we all know that founders do not like to give up control over their startups. And venture debt financing can effectively balance the cost of capital when used appropriately to fund working capital requirements. And venture debt, based on our research, we found that venture debt penetration is probably between 2 to 4% as it stands now, all right? And we expect it, right, to grow between 5 to 10% of the total venture capital funding in the coming years. And that is going to be very useful for those of you who are looking to adopt venture debt as part of your growth life cycle. And without further ado, I just want to share with you the QR link to the report. So you click on the QR link or you do a scan, and this will be the report that we have collaboratively launched with Genesis Ventures. Thank you very much.
Thank you, Patrick, for the most wonderful insights and also the very, very smart QR link. I hope everyone downloads it and enjoys it as much as we have. Without further ado, in panel 1, we have Professor Annie Koh, who will be moderating the topic, the dual role of debt and equity financing for venture-backed companies in a hyper-liquid capital market. Professor Annie is the Professor Emeritus of Finance, Lee Kong Chian School of Business at SMU. Over to you, Professor Annie.
Thank you very much for your great support. I want to say a big thank you to the founders, co-founders of Genesis Ventures. I think this is a great forum, and you have so much diversity. So we are going to start with panel 1, and panel 1 is about engagement, actually, because we have a perfect panel for you. We have people who are actually in the space of venture capital, venture debt, and of course, bankers. And it's very important that we hear from them very quickly. This is such a big topic. I think essentially we are dividing this conversation into 3 parts. We're going to talk about the hyper-liquid market. And I think the data is obvious. You have been reading about the amazing numbers of IPOs, SPACs that have gone on to the markets. But we want to address this issue from a very macro perspective. And in a little while, I have 2 wonderful panelists on site here at the greenhouse with me. So a warm welcome to SMU Greenhouse. With me on the panel, we have Andrea from PwC and we have Jeremy Lowe from Genesis. But off-site, we have 3 sterling voices representing the investor market. So let's start with Andrea. Andrea, I really like your profile, and I'm happy that PwC is a partner to Genesis Ventures. So in your role as head of Southeast Asia, corporate finance and partner of PwC Singapore, I think we would love to have your thoughts immediately on what are some of the macro trends, and with so much liquidity in the market, where do you think a lot of our investors should be focusing their attention on?
So let's take a step back and ask, why is there so much liquidity in the capital markets? 20 to 30% of the US dollar money supply was printed in the last year. Let that sink in. Usually central banks are quite conservative and we're expecting slow, steady growth. But there have been unprecedented levels of stimulus in the economy due to the COVID response. So what happens? We haven't even seen the velocity of money come into the economy yet. For much of the last 6-9 months, we've effectively been in lockdown. Once the velocity of money kicks in, we're going to see inflation. Now, we haven't quite seen it in the CPI numbers yet, but inflation is coming. So what does that mean for us as an investor? Can you put your money in the bank? I think at the moment you get less than 1%. In countries such as Germany, if you have more than X dollars in the bank's actually going to deduct money from your account. Then you're thinking, do I put this into the equity markets? Oh gosh, are the equity markets a little bit overheated at the moment? What does that leave you with? What's exciting at the moment? People are looking for higher yields, higher returns. Venture capital investing. That's the exciting part at the moment, and that's why we're here today.
Okay. Thank you, Andrea. I actually like a quote that the team has prepared for me, that your greatest excitement is in closing a deal, looking for a deal. So can you kind of elaborate on that? What's so exciting about that?
My family says that I'm happiest when I'm doing deals and grumpy when I'm not. So whether it's closing an M&A deal or whether it's trying to raise capital for my clients, I'm very excited to be there in the trenches with them, helping them secure either capital or, for some of our investors, an exit mechanism.
I'm going to move to Kilok actually, all right, because Kilok, you would come in perfectly for this next flow that I'm looking at. And of course, everybody knows Mr. Chua Kilok. He's the president and CEO of Vertex Holdings. Tremendous background, many, many years of having looked at ventures, those wonderful, all right, investments that Andrea gets so excited about. Kilok, would you look at venture debt for your portfolio of companies? Would you combine, equity and debt for your portfolio?
Generally, for us, we do encourage our portfolio to access venture debt when they are ready to do it. Typically, like what Jeremy said, venture debt companies are companies which are in the growth stage, and they may not be ready for next round financing. But at the same time, they would like to continue to grow with certain capital to get to that stage. So without the dilution from the equity, that seems to be the ideal situation. You pay a bit of interest, give a bit of warrants, and in return for the continuation of the growth. So generally, we do encourage our entrepreneurs to access that capital when you are ready. However, sometimes, occasionally, we do have a situation whereby entrepreneurs are not really suitable for venture debt. In those cases, we told them not to access venture debt because they are just wrong candidate for venture debt.
I'm going to switch gear to the debt side of the business. And I guess I would like to engage my panelists from the virtual platform first, and I'll come to Jeremy in a little while. Yeah. So, today's market, low interest rates. So I actually would like to have Mr. Azora Kito-san from the Azora Bank. And this same question I would also like to direct to Pak Tigo so that we can hear from both of you at one go. So given the tremendous low interest rate environment, a big driver for the liquidity in the market, and a lot of investors, both short-term and long-term investors, are also seeking higher returns. How do banks then think about increasing your return on loans given the current low interest rate environment?
In Japan, the interest rates have been low for about 10 years. The previous Prime Minister, Mr. Abe-san, started a new economic plans in 2012, included the injection of a large amount of money into the money market. And 2016, started a negative interest rate policy. In a way, Japan has ahead of other countries in terms of experiencing the ultra low interest rate. And our other banks, almost all Japanese banks have had to adapt to this environment. So our typical ways to improve return were to increase fee business like M&A, placement fee, and shift allocation with domestic debt market to specialty finance like LBO and US market debt, and increase exposure to other asset classes like private equity. And we have used a combination of the above. Thank you.
Thank you very much, Ito-san. So absolutely, diversification into other markets. What about you, Patigo? I know rupiah interest rates is a lot higher, but I'm very sure that you're also looking at how to grow returns for a bank perspective.
Thank you, Annie. So I think the way I see it, it's probably going to be a lot more boring answer, because the way I see it is more on the cost base, right? When there's a lot of volatility in terms of revenues, us banks, we have a heavy cost base that we need to concentrate on. Now, the cost base is not just the regular cost base in terms of premises, platforms, and so forth. That's one piece of the cost. But the second piece is on the cost of fund. Right, and with us, with CIMB Niaga, we've been really focusing on this in the past few years to really increase the CASA, the current account, savings account percentage. So we're at about 63-64% CASA based from the deposit, as opposed to it was about mid-40s about 4 or 5 years ago. So that's a second piece of the cost base. The third piece of the cost base of a bank is the provision cost base. And that's what we need to look at. How much provision that we have to put aside given the portfolio that we do have. So if we control those three buckets, the actual platform cost base, the actual cost of fund, the provision cost, you're probably 70-80% there. Now, on the flip side, on the revenue side, on the loan side, given that we're trying to make sure that the cost base is actually very, very thin and very, very competitive, then you can have your pick in terms of who do you want to lend to. Otherwise, you're going to be lending to those guys that other banks don't want to. So if you have your first pick, most likely is going to be the much better credit. And thus, again, the provision expenses, the cost base of that line item is going to be much, much more competitive.
So this question is just for you, Jeremy. So are you finding it hard to convince founders to take some venture debt from you, given the abundance of equity? You know, they have the likes of Kellogg and everybody else. So does venture debt compete with venture equity?
Well, first of all, I have to say that the Kellogg is a mentor of mine, right? So when I first started on the venture equity side, Kellogg was a very nice guidance and mentor to me, so I have to thank him for that. And then now I have two very senior bankers. I started my banking career with DBS Bank, and I've had two very senior bankers on the line as well. So I just want to say that venture debt is a very nice mix, and it's a hybrid product of both venture capital and debt, right? So it sits right in the middle there. And picking up on what Pak Tigor says, right, about going after the customer base that nobody wants, right? So venture debt really picks up on the very fast growth companies. But, you know, banks are a little bit very wary of them, right? Because banks want companies that have been around for 20 years, 30 years, have a very good track record. They know the promoters who has been around the scene many times. But when you're dealing with a startup company, right, the founder could be someone who, you know, may not even have finished their undergraduate courses, right? But they have launched a business. They're going after, you know, a traditional incumbent. They're very fast growth. You know, they're very attractive to investors like Vertex. And at a certain point in time, they become a candidate for debt, right? And debt should be looked upon, and venture debt specifically should be looked upon similar to how growth capital is, right? So when you are looking at a startup company that's growing and they've reached a certain level of traction, then growth capital becomes very important, right? Because growth capital basically addresses the need of operating working capital, right? So like, for example, accounts receivables, right? How do you actually bring in money earlier into the balance sheet so that you can actually recycle the capital to grow the company faster? Secondly, venture debt should also be looked upon like a structured capital, right? So by balancing debt and equity, you can actually reduce the cost of capital that you bring into your company. You reduce the equity dilution as well, and essentially balance up the cost of capital. And that's exactly what the banks do for the corporate customers. So that's in a nutshell what venture debt does.
Right now we're starting panel 2. It's a very, very interesting one. It's called Profit First, Impact at Scale. Identifying meaningful impact investment opportunities in Southeast Asia. I'm moderating this panel. My name is Martin. I'm co-founder and partner of Genesis Alternative Ventures. Let me start by introducing our panelists. First up, Melissa Kang. Melissa, very, very pleased to have you here. So Melissa is the founder and managing partner of GI Capital. It's focused on private equity and impact investing. Prior to founding GI Capital, Melissa has had a long track record of impact and ESG investing, which I'm sure I'll definitely be sending a lot of questions your way. And seated here as well is Ben, my fellow partner and co-founder at Genesis. He is a strong believer in giving back to society, and he himself really is the key driver in Genesis' impact investing journey. Dave is the co-founder and managing partner of Capria Ventures, also an LP in Genesis. So one of Capria's key investment criteria is that companies must have commitment to deliver superior returns along with scale impact and global class ESG. So he definitely knows a thing or two about impact investing. So Dave, a lot of questions will come your way as well. And last but not least, Dr. Felix Schneider. He is the investment lead for DEG's FinTech investments in global markets. DEG is a development finance institution and subsidiary of KfW Group. It promotes private sector companies to contribute to sustainable economic growth and improve living conditions in these countries. And I would like every panelist to share how they got started on their impact investing journey. Melissa.
that is the time when I realized, my God, I can no longer wait for the government to do something about it, or some people to protest on the street, or NGO. Maybe I start thinking, right, who can make these changes? Shareholders of company. You can influence management team. Management team produce goods that are safe and meaningful. We take care of the environment. So that is the time that I decided to shift my career, and I had a great opportunity of joining IFC. I became the head for IFC's East Asia funds business and managed $1 billion for them, where I learned how to invest in ESG. Then it's been now almost 10 years, and that journey continues.
Wonderful sharing. From DFI to DFI. Dr. Felix, over to you, please.
Thank you so much. Thanks. And hi to everyone from Cologne here. It's a great pleasure to be with you, although virtually. I mean, someday soon I would like to visit you all in Singapore. And DG, which is one of the world's largest development finance institutions and impact investor, was looking for someone to start out and develop a fintech investment strategy and build up a portfolio of fintech investments in global emerging and developing markets. And yeah, to me, this was an irresistible opportunity at the time and challenge, which I gladly took on now more 3 years ago. And this was my personal start into an incredible journey of impact investing, where since then I've had the privilege every day to meet and work with great entrepreneurs and teams that are extremely motivated and skilled in building out ventures that make a real difference and impact in their ecosystem and countries. And yeah, to date, we are proud that we have made a good number of investments in various fintech companies across Asia, Africa, and Latin America. And I think it's getting more and more exciting every day as more and more opportunities are opening up and the ecosystem is growing and growing. And yeah, we're very happy to be a part of that and contributing with capital and also expertise.
Thank you very much, Dr. Felix, for sharing. So we'll fly over to Seattle now and get Dave to say something.
Hi, everyone. Good to be with you all. I started my impact journey with microfinance. About 15 years ago, I read a book by Muhammad Yunus that told his story of how he set up, which became the largest bank eventually in Bangladesh, called Grameen Bank. And I was hooked with the concept of a model for micro lending to low-income women, which had a far higher repayment rate than what middle-class people were paying back on their personal loans. It just kind of defied logic, but it was very powerful. It created dignity for people to have more self-reliance than to rely on handouts and ability to provide for their family in different ways. A very powerful model. I was involved with helping set up a group called Unitas, which helped to replicate and support entrepreneurs replicating the microfinance success in Bangladesh in places such as India, Southeast Asia, Africa, and Latin America. And we started to be one of the first private venture investors that was backing these new generation of entrepreneurs who were really building the next generation of microfinance businesses. Many of these now are very scaled. Some of them are chartered banks in places like India and other places. And that's my journey in there.
Thank you, Dave. We'll come back to Grameen in a while, but right now back to SMU and over to Ben.
Thank you, Martin. My impact journey began with your impact journey and Genesis impact journey in 2018. So we're very, very new to the impact space. And if I remember, it happened in the boardroom one day when we were just beginning to get the fund up and running. And Jeremy, Martin, and myself had just come together as a team. And we said, look, please God, we'll build a successful fund and a successful business, but there's got to be something else to it. How can we give back to society? And we thought and we spoke, and it took us 45 minutes to think about all the wonderful ways in which we could potentially do some impactful investing. And then we left the meeting, and for the next 3 to 4 months, didn't think about it at all, because it was crazy to get a fund up and running, and you guys know how it is. As it would happen, the gentleman sitting on your screen in Seattle, Dave Richards, was in Singapore for a meeting. we had a meeting, and we understood that Capria at that time was looking to invest in Southeast Asia funds, and we brought along with them a very strong impact in ESG knowledge and experience. So together with Capria, Jeremy Martin and I set out to really build what we hope will be a very key part of Genesis moving forward, and that is to selectively invest in Southeast Asia high-growth tech companies that have a strong, impactful mission to them. I think at this point, there are about 6 companies in the portfolio, which almost make up half the portfolio today, that have got strong, impactful missions. And we're very, very proud to say that on the return side, many of these companies as well, stacking up against the non-impactful companies. So that was our beginning days in impact, and very happy to be on this panel.
Don't go yet, Ben. Just before you go, so how would you describe impact and ESG to a 10-year-old?
A 10-year-old, wow. Okay, so how we put it internally and how we talk about it with companies, and Dave, we've spoken about this at length in our bi-weekly sessions. ESG is don't do all this bad stuff, and impact is do the good stuff. So it's really two sides of the same coin. We consider ESG to be reputation management and the stuff that companies really shouldn't be doing, and some of the good stuff that they should be doing around governance, for example, and environmental and social initiatives. Impact is the positive stuff that we want to see scaled together with the model of these businesses. So as these businesses scale and grow, so too should the impact. It should be connected with these businesses as they grow in size, so that the impact as well scales into communities at large.
Guiding our growth going forwards is the SMU 2025 strategic plan. SMU has selected 3 strategic priorities as focal areas where our cross-disciplinary strengths intersect with the future needs of Singapore and, very importantly, the region. The strategic priorities are 1, digital transformation, 2, sustainable living, and 3, growth in Asia. Now, to realize these strategic priorities, we require the support of an enabling infrastructure, which we are calling our 4 I's. The first I is industry. We're strengthening our industry engagement through formal collaboration and joint projects. Next is internationalization, and we'll do this by expanding our international footprint and our connectivity. The third I is integration. We're pursuing an integrative work in practice in multiple dimensions, including multidisciplinary efforts in education, research, and integration with the city. And from my point of view, very importantly indeed, the last I is innovation. We aim to energize a campus-wide innovation and entrepreneurship movement through the Institute of Innovation and Entrepreneurship, or IIE for short.
Can you please share some of the hacks that you have that work for you and your team, especially during this tough period with the PSBB restrictions in Indonesia?
I don't think during that time there is many hacks that work, rather than really spending a lot of time trying to for more than a hack or not. So I think we were incredibly lucky that at the time our traffic to buy groceries online because of the lockdowns were happening, and that we had to increase massively our operations and increase our fleet, was the exact time that the transportation use case was dropping because people were not going to the office or why not. So we had the chance to hire a lot of the Grab, Gojek's drivers that were losing their job. And then we would basically convert them into a happy, fresh drivers. So the talent pool was actually really, really big for us to tap into them at the right time. That's not a hack, it's just really being lucky. And that's probably one of the best situations that we've had in terms of scaling up our fleet, and the fastest that we've ever done it. And that just basically because we could access to that already trained, accessible talent pool.
Actually, the other question that we had was, you know, the pandemic last year. I was on a webinar with Bruce. It was real. We were all stuck at home somewhere. Has seen some startups being badly affected. Some have thrived, in fact. But you know, can you share with us some of the hacks that took you and the team through this tough period? Maybe Peter, you want to share a little bit first?
Well, hacks that took us through the tough period was, I think...
Apart from wine.
That's the one I use the most. It seems to work with me very well. So I think that, first of all, the macro picture has improved. I think we went through the great panic of the depth of the epidemic last year. Nobody was doing anything. So to a certain extent, one hack really was that the market has kind of begun to turn around. The second hack, of course, which was super important, was we had to look at our burn rate. And we've cut our burn rate by more than 50% since December. And we plan to go even deeper because we had a situation where we had a lot of money and we spent a lot of money. And there was this belief we'd always be able to raise a lot of money. And this is not the real world. So we had to cut a lot, which we did. We had to streamline quite a bit, which we're doing. And I think these are obvious hacks, really. So there hasn't been a bit of magic that we've done. It's all been basic focus management type of attitudes to get the business moving in the right direction again.
Well, so maybe the first question, let's ask Jadip, right? How does digital credit models help promote financial inclusions? You know, and what do you expect Trusting Social to play a part in, right, in the markets that you serve?
Sure. So to our mind, there are three primary benefits that digital credit products and digital models enable. The first, you talked about it yourself, Jeremy, access. For underbanked consumers in our countries, having access to the right loan product itself is a significant benefit. So for instance, this year, almost 15 million consumers will get access to financing from regulated lenders who use our capabilities. Typically, these tend to be $1,000, $2,000 loans around 2-year tenor. So this is a real impact from a financial inclusion standpoint. The second benefit is in reducing the cost of operations. So digital lending reduces the friction that you see in traditional lending. Think about when we go to a bank to get a loan, there's a lot of paper that is filled. Digital lending removes the need for paper documentation. Or the lender needs to send someone to the potential borrower's house to verify they actually live there. We can, again, do that digitally. So what digital lending enables is a smoother, faster process with less drop-offs for consumers who find it more challenging to go through the hoops of traditional financial services.